all of the measures that we're taking are actually going to hurt affordability in the future. Am I way off here?
No, you're right. We're kind of impacting the next generation of homeowners.
Welcome to Supply and Demand with Adam Nadler. This is a podcast dedicated to the real estate market in Canada, available now on YouTube, Apple Music, and Spotify. Jeff Mudrick, how's it going, man?
Oh, it's going great. How you doing, Adam?
Doing good. Market's a little wonky right now. We just heard some big news that Q3, the Bank of Canada seeing a $500 million loss on their balance sheet. So explain to everybody a little bit about what that means, if it even matters.
There's no real direct correlation between that and what's going to happen in a few days from now or on December 7th in terms of interest rates.
Hi, my name is Adam. I am the owner of Vision Real Estate. Thanks so much for tuning in again. And if you're new to the channel, hit that subscribe button and the bell so you can be notified every time I put out a new video. And if you enjoy this video, hit that like button to help the algorithm push this video out to more people like yourself. And if by the end of this video you think to yourself, hey, you know what, I'd like to chat with that guy about real estate, feel free to click on the link in the description below. That'll connect you to a calendar where you can book a quick 15-minute chat with me at a time that is most convenient for you. Or feel free to just email me any question you have directly to adam@visionrealestate.ca and I will get you a personal video response within 24 hours.
We don't have any inside knowledge because they, for the first time in forever, they've seen such a huge loss. That doesn't necessarily mean we're seeing a 1% increase or 0.75% increase. So there's no real direct correlation there. But it does tell us that what the Bank of Canada is doing has maybe not done exactly what they intended to. But we'll find out on December 7th what that means for interest rates.
So what should we be expecting December 7th?
I think the last time we had spoken, we talked. It was just before the last announcement, I believe, and both of us kind of had the similar mindset where we thought there would be a 1% increase between October and the new year. So we saw 0.5% on October 26th. I'm still, when I'm pre-approving clients, if they want a variable rate, I'm pre-approving all of them with at least a 0.5% increase scheduled in there. So that'll be my quote unquote prediction. Another 0.5%, and we'll see.
And in terms of where we're sitting with rates, both fixed and variable, and I know that this is such boring stuff a lot of the time to be talking about, but it really affects people's decision-making process and it really affects how the market is perceiving the future impact on housing pricing. So where do you see rates going over the next little while, and how do you think it's going to affect the market in the next, let's call it the next 3-4 months?
3 or 4 months. Like right now, we're sitting around the 5.5 for fixed and just below that for variable. Although variable rate's going to increase in on the 7th. So variable rate or fixed rates we've seen over the past 2 weeks, we've actually seen them come down. We've come down not dramatically, but it's not making headlines. But they've come down and they're a bit more enticing, especially those shorter term fixed mortgages. And I think that's going to likely be the trend for the next 12, 18, maybe 24 months. Is let's people who love variable rates love them, not because of the rate itself, but more so all the other benefits associated with the variable rate. So those variable rate clients, they're still going to be variable rate clients. Those fixed rates clients, I personally am not seeing, and my team, we're not seeing clients jump on that 5-year fixed, even though it's a little bit cheaper than a 2, 3, 4-year term. Where rates haven't been this high since 2008. The advice is, why are we locking in for 5 years at the highest that it's been at? So let's peak at these 2, 3, 4-year terms instead, and kind of kick the rate conversation down the line a couple of years. So my thought over the next 4 months, fixed rates probably going to remain somewhat steady as to where they are right now, and we know variable rates going to increase next week.
Now there is a question I want to ask you about investor clients in particular, because I am seeing a lot of investors come out of the woodwork right now, and they are looking at the fixed rates and the variable rates and going, hey, we've probably peaked on inflation. the let's say 12-month prediction going forward is likely going to be a slow, dull ache in the marketplace, moving into a little bit more of interest rate drops coming into Q1 of 2024. This is probably a great time to buy while rents are so high, and we can just kind of wait that process out and then refinance in 2024. Is that a conversation that you're having a lot of right now?
Weekly with new investors. So everyone knows that everyone in the past couple of years bought at a quote unquote high time in the market, kind of. So now a lot of these clients are seeing housing prices dip, and clients who did want to get into investments already have one or maybe two places. And you're right, they're coming out saying, oh my gosh, housing prices are this low. We know they're likely going to, the housing prices are likely going to increase again. I don't think that's I'm not making any bold prediction there. Prices will come up as interest rates kind of even steady off, as long as they're not continuing to increase. I think once people kind of get used to the new rates, buyers didn't leave. They're just they're on pause right now. So a lot of my clients who are investors are calling saying, hey, what's a prediction for where this property can land, what rental prediction can we expect here? What is the market rent in 5 years at a 2% appreciation? What does that look like for my property? Because purchase prices are so much lower right now, the big thing for investors is just the smaller down payment that's required. Along with the down payment, we also get smaller, like lower land transfer taxes, low appraisals are a different conversation, but there's all this other savings with these lower purchase price amounts and the added benefit of appreciation down the line.
I'm glad you brought up appraisals. Even though that was a big passing statement, I did want to kind of poke you on that for a second. Appraisals have been
Yeah.
a huge, huge problem lately. What's going on with that?
Well, here's the thing, like if you're working with the right realtor, and I guess mortgage broker as well, but it's the realtor and the client who are majority of the time figuring out where they want to offer, what range they want to offer. And if you're working with the correct realtor, appraisal should never be an issue, because that realtor will be in constant communication with the mortgage broker. And for myself, for example, there are tons of different ways. I'm not going to get into it now, but there are lots of ways we can get a semi appraisal on a house for free for the client without a client even putting an offer in on the property. So there are ways around just to see, hey, we can essentially trigger, will this property need an appraisal, or does this property not going to need an appraisal based on these purchase prices? We can, if you're working with the right person, there are ways to kind of finagle that. So I'll say this, for me, an appraisal has not been a problem over the last year. I've never had an appraisal come in short, or if we had, then the clients knew that it likely would, and they had some backup cash if it was required.
Okay, so you touched on a few really important things that I just wanted to highlight, because it's, that age old saying that, never let a good disaster go to waste. And that's exactly what's happening right now. Is there's just massive panic in the market. I mean, the panic is starting to, subside a little bit now, but that may just be a seasonal trend as people gear up for the holidays and are kind of dialing back on their decision making process regardless. Having said that, though, as we kind of come back in to a more active marketplace in the springtime, where things will typically pick up anyways, when we see the overall activity increase and people are looking for the angle. The couple things that you pointed out is the people who are taking advantage of this market are taking advantage of a lower purchase price, meaning that they're saving money on a down payment, they're saving money on a lower land transfer tax, which amounts to tens of thousands of dollars, and just saying to themselves, well, if we had that money we were ready to buy before, let's keep that in cash reserves and put it towards a higher interest payment for the next year, rent it out at all-time high rental rates, and then revisit the conversation with the bank in a year or so from now where we can score a lower interest rate and instantly put ourselves in a positive cash flow situation. And all the while, the actual money that we had banked to make this investment was the same the whole way through. Is that kind of, am I
Yeah.
kind of hitting it?
I'm going to give you a specific client example of exactly hitting exactly on what you said, but just with some concrete numbers. Had a client who was approved to purchase a property up to $2 million. They didn't want to go there, and fine by them. And that's okay. This was earlier on in 2022. Were approved up to $2 million. However, their specific budget, because of their down payment, they actually had a couple, like I think they had 200 or 250,000, something like that for a down payment. So they didn't want to buy at 1.5 or 1.2 even. That's where they were kind of looking in that $1.2 million range, which would have required a down payment of 240 or 240,000 bucks, right at the top end of their cap. So they waited. They just bought a property. So this is kind of how we worked it. They bought a property. It was under $1 million for this property. Okay. What happens when a property goes under $1 million? They bought it 999,999. And the reason
You
for
can
that
less
is
than
because
20%.
exactly you can have the minimum down payment, which is $74,999. So
Wow.
instead of these clients spending $240,000 on a down payment, they spent $74,999,000. What happens there? Clients have in their pocket they had $170,000 left. And they had all this purchasing power because they didn't buy at the top end of their budget. So a month after they closed on their property, they bought an investment property in this lower market with this higher rent, because they had all those cash savings from putting the minimum down payment. So it's all about how to structure a deal properly in the market that we're in. These people are laughing now. They're spending a lot of cash on interest. Like the interest rates are high for sure, but they're not doing this for the next 2 years. They're going to hold these properties for the next 10, when interest rates kind of settle down.
Yeah. So the concept of cash being trash only holds true in so much if you're actually just hoarding it and not using it wisely, because you can then take that extra cash that you would have had to have put towards a down payment prior to this situation, get the same product, they get the same product with a much smaller down payment, get a much higher rent on it, and then take that extra cash. You could even invest it in private capital markets and arbitrage the interest or dividend returns on those to pay the extra mortgage costs on whatever now you've secured at a discount. And so there's a lot of opportunity out here for investors in particular, I think. And
And and it's just great because these investors, or even first time home buyers or second and people who want to upgrade, it's not, as I'm sure you're aware. I remember you and I spoke literally a year ago where a house came on the market. I know you called clients and said, we got to go see this because it's exactly what you want and it's probably going to go soon, so let's get in. Whereas now it's not that same rush in certain markets. So people are having the time to find what they actually want, which is just it's at a lower price too, which is kind of nice for buyers.
yeah, like you can get an inspection. You're not going
Yeah.
in blind. That's, people forget about how scary that is. But yeah, I do think that there's tons of opportunity here. And it's interesting that you're seeing so many investors come out of the woodwork, because I am getting calls from investors. I'm getting calls from, I mean, we have shared clients that had refinanced at extremely low rates back, at a year ago, just over a year ago, and now have capital ready to go and fire on this market. And I do think that there's tons of opportunity there. How are you finding the conversation is going with upsizers? Because right now we've got a prime market for that, but the numbers are pretty tight. So how are you
Mhm.
managing with clients like that?
Yeah, so it is a bit of a touchy subject, with upsizers. I think there's a lot of opportunity. However, the biggest challenge that most or every mortgage broker is facing right now is just qualifying clients. So the stress test is hurting a lot of folks where you would take your interest rate, add 2%. So everyone right now has to qualify at 7.5%, as opposed to earlier this year, everyone was qualifying at 5.25%. So this really, really is limiting people's affordability. So even if those upsizers have lived there for a year and haven't seen a huge increase in the value of their property, or haven't gotten, a sizable change in their salary or income, then it's going to be challenging. But for people who have a lot of equity in that property and have stayed there for 3, 4, 5, 6, 7 years, and during that time, their income has changed in a more positive way, there is a lot of opportunity there. Are you seeing something similar?
Yeah, I think the people who just bought in 2018 are fearful right now going into 2023 if they're, having a 5-year term mature in the next few months.
Oh yeah.
That's a scary predicament for those people. So how are you dealing with those people?
Well, it's actually really interesting. So I think we had a similar conversation a few months ago, and I forget what my answer was back then, but I know it would have changed today. So just because of the activity that we're seeing on these renewals, most renewals, so when a term expires, whether it's a 3, 4, 5 year fixed or variable term, clients have the opportunity to sign up for another term, do it all over again. However, what I'm seeing happen a lot is people who, let's say, they had a 25-year amortization, their term in 2018, their term's coming up for renewal, they have 20 years left on their mortgage. What I'm seeing a lot of people do is called a refinance, and we are re-amortizing your mortgage to maybe 25 or 30 years. And that way, even with this increased payments, or even with the increased interest rates, the payments are actually staying the same, if not a little bit lower, because we're re-amortizing the mortgage. So what essentially re-amortizing just means that more of that money that you're paying monthly goes towards interest and less towards principal. But if you need that in these times when interest rates are super high, there are always ways after the term's up or during the term that we can optimize that mortgage. But a lot of people, I'm finding, those renewals are turning into refinances and extending that amortization, which reduces the monthly payment.
The one thing that I'm curious about is that I was always under the impression that there is a limit to which you can amortize a mortgage. And now I'm seeing that because people have hit their trigger rates on like a static payment variable rate, they're extending the amortization into a number of years that I'd never heard of before. I'm
I've seen
seeing
53. Yeah.
yeah, so
53 years.
what's up with that? Like how is that possible?
It's not. It's essentially a way that lenders saying, we know that it's a really tough time right now, and we know interest rates are likely going to come down again and throughout the term of your mortgage. So with a static payment on a variable rate, because when interest rates go up or down, the percentage that you're paying monthly is going to change the allotment towards interest and principal. So um, for example, let's say your amortization is 30 years and interest rates go down. Well, if you log in online, you'll see your amortizations. Oh, I'm actually at 26 years. And then if interest rates go up, oh, my amortization is at 34 years or whatever it is. So they're not saying, hey, you can adjust your payments to make it seem like you are paying at a 53-year amortization. They're just saying if everything stayed the exact same, it would take you 53 years to pay off your mortgage, which they know it's not going to stay the same forever.
Oh, I see. I see. Okay, because that's really interesting. There was an article about that recently, and I was wondering about that. So overall, your I know we have to do a prediction video. I actually just did a 2023 prediction video, and I was quoting
Yes.
I was quoting a lot from Benjamin Tal. Do you think? I mean, and he was very, I mean, uncharacteristically targeted in his predictions, which he's normally not. He said that he thinks the Bank of Canada is going to stop at 4.25 for the overnight rate. What do you think? Agree or disagree?
You know, it's it's everyone's guess. I guess this is turning into my prediction rate. I'll go. I'll go with Ben. This is my prediction. I'll go with the same number, four and a quarter. That seems about right. Yeah, let's see, because everything can change, right? If there's another huge wave of COVID, I know everyone's sick right now, but if there's a huge another wave or whatever happening is overseas, if the yeah, it's very challenging to say. The 4.25 sounds about right.
If nothing changed. You're saying if no disaster
Correct.
spike hits us and we end up in some kind of crazy situation that we had not foreseen, if everything stays relatively the same as it is right now, then you think 4.25 is
Yeah,
reasonable.
I would actually might go a little bit. I might go a little bit higher than that. I might go
Really?
4.5. Yeah, because right now we're at 3.75.
Mhm.
So 3.75 plus another 50. I'm predicting another 50 basis points on the seventh. Right there, we're at four and a quarter. Um, I think it might hang around there. Maybe another half, or maybe another 0.25% increase at some point throughout next year, um, and then hopefully steady off.
There is something that I know you are kind of giving people a heads up about that is going to be changing coming soon. And what exactly is that?
Yeah, so there's the notice sent out last week or by one of the insurers. So what an insurer is like a CMHC, or there's two other insurers, Sagen and Canada Guarantee. And Sagen, the probably the second largest, came out and said, "Hey, I'll break it down." They essentially said, "Hey, for anybody who has an insured or insurable mortgage, so if you put less than 20% down, or if you have a 25-year amortization and your purchase price is less than $1 million, then because of these increase in interest rate hikes, if you can prove that you have financial hardship and you're having a very challenging time to make payments, we will consider extending your amortization as long as the lender's on board up to 30, maybe 35 years, which will significantly reduce monthly payments or biweekly payments for homeowners. The reason they're doing this is because they're getting pressured by people saying, "Hey, we can't make our payments. We signed up for a 2% interest rate. Now it's at 5.5. Um, we don't. They don't want everybody to have to sell their home. So this is kind of something that they are putting out there, that the assumption is the other two insurers, CMHC and Canada Guarantee, will also fall on board with. And then from there, it gets pushed to the lenders. So the lenders also have to be on board. So that's what we're waiting on right now. But this is such big news for anybody who, had to put less than 20% down, who is feeling the pressure of the increase in interest rates on their monthly payment. And if there are some financial hardships, hopefully some relief is coming soon.
Okay, so on the surface, this sounds like it's gonna make the lives of people who are suffering a lot easier. Um, and in the long run, correct me if I'm wrong, but this sounds to me like more building up, more pressure put in pent up demand over the long run because it's just going to force people to stay put and keep supply of housing low, which is going to keep affordability in a really dark place moving forward. So even though we see price suppression now, all of the measures that we're taking are actually going to hurt affordability in the future. Is that am I way off here?
No, you're right. Listen, like I think their point of view is, hey, let's help current homeowners. And I think your point of view is, well, that's by helping current homeowners, we're kind of impacting the next generation of homeowners, because people aren't selling or can't sell because the other issue is that there's no set stone rules yet. But if it does come into play, the question is, hey, you know, you're extended to a 30-year amortization to get out of this mortgage. Do you have to pay off? Do you have to bring it back to a 25-year and do these huge lump sum payments? Like, what are these rules? Because I feel like there's always something else. What's in it for me? What's in it for the insurer to do this? So, but anyways, it's something that's very, very interesting and has the potential to help a lot of people. but let's wait to read the fine print on this and get back to you.
Very interesting. So there, it is very possible because supply is incredibly low right now. There's just not very much out there on the market, and people who are actively shopping are, yeah, maybe able to get a better deal, but they don't have a huge variety to select from. And I think that moving forward, these are just those beginning steps that will create that pressure cooker that we're kind of tightening the lid on now, but the pot's not hot yet, but the element is going. And so I think that that's what we're seeing. And then moving forward into the new year, we're also putting, I mean, I did a whole video on this. I think it's completely ridiculous. A blanket ban on foreign buyers for 2 years across the nation.
Yeah.
Um, I mean, what are your thoughts on that?
Yeah. So I'm sending out some information shortly just around the impact that this might have and whether it's going to have an impact or not. However, I work with a lot of foreign buyers, and there are ways. It is a blanket ban, and it's meant to stop people living in another country who have no intention on living in Canada. It's stopping them from buying a place in downtown Toronto or Vancouver or or Calgary, to buying that place and renting it out or keeping it empty and just hoping for appreciation. However, for those clients who maybe have just moved to Canada or planning to move to Canada, they're currently foreign buyers, and then they're just, there are ways around this. But this ban is meant strictly for what I said earlier, people who no intention of ever moving or living in Canada. It wants to stop those people from purchasing houses and leaving them empty or renting them out to Canadians or permanent residents.
And in terms of these foreign buyers that we're talking about, I mean, according to CMHC, we're talking about 1%
Maybe,
of,
yeah, maybe.
if that. So do you think that this is just kind of some political maneuver stunt to try to, help whoever is promoting it to, show like they're making a show of helping affordability in Canada?
I know you know the answer to that question already, and
Yeah,
the
it's pretty
answer
loaded.
is heck yes. Yeah, is it going to have a big impact? Like, in my mind, absolutely not. It's a big headline. Is that going to increase affordability? Is that going to, decrease the cost of rental? No, absolutely not. But it is a big statement. I work with like a good handful of foreign buyers who already have a lot of properties here, who want to purchase more, but they can't. They won't be able to for at least 2 years. And then I guess in 2 years they'll reassess and see what they, you know, let whoever it is will reassess and figure it out if it was beneficial or not from a
It
from a
seems
housing standpoint and probably from a political standpoint.
it seems like the thing that is really pushing demand up, or at least going to be increasing the influx of demand, is just a lot of immigration, from what I can tell. And the government's been very bullish on immigration. And over COVID, the government was claiming to, have plans to bring in close to 500,000 people a year. Um, and we actually came fairly close to hitting that target, I believe, over the last year or two. And the way that we have seemed to have done that, at least in the articles that I've read, and according to the chief economist of CIBC, is through students. So we had a bunch of international students here, and then instead of during COVID bringing in, hundreds of thousands of people from outside the country, we just started handing out PR status to people who were already here as an international student. um, Now, how do you see immigration playing into 2023, where we know we're going to have, continue into a more volatile market, with supply low? Are we gonna continue seeing foreign money being a huge impact? Because it sounds like we've got factors pushing on both sides. Like we've got foreign buyers being banned completely, but then we have a whole bunch of immigration happening and a bunch of students being given PR status. Now, where does that
Or
lead
applying
us?
for PR and then it's taking time. But yeah, for
Right.
sure. Like yeah, it's a great question. I think there are actual it's so a couple of things to note. One, you know, can foreign buyers over the next 2 years, can they purchase a property in Canada? The answer is no. And they actually it's great because I think it's great. If the answer is no, listen, we got to follow the guidelines that are given to us. There's no ways around that. And it's really great because the governing bodies are implementing 10,000 like thousands of dollars of fines to anyone who does assist in these types of transactions. So there's actually fines in place for realtors, mortgage brokers, lawyers, whoever else is kind of aware of it, and a lot of obviously license issues there. But that being said, students, international students, people who have applied for their permanent residency, people new to Canada, this foreign buyers ban does not impact any of those people. So like you said, because immigration is the government is putting a very big emphasis on that. There's gonna be a ton of people still purchasing properties over the next 2 years.
Interesting. Okay. Well, I mean, that's really insightful. And I'm very much looking forward to the information that you're going to be putting out on this because this is going to be a hot topic moving into 2023. And we're in such a state of bipolarism in the economy where it's just kind of swinging from one side of the pendulum to the other, and it's moving so quickly that obviously these snapbacks to either side seem to just be happening more frequently. um, let's definitely stay in touch on it and see where things go. I always love picking your brain to see what you think is going to happen because you've got your finger on the pulse. So thanks so much for taking the time to chat again. I really appreciate it.
Thanks, Adam. Awesome. Looking forward to it.
Thanks for listening. Don't forget to like, follow, and give us a review.